Hi there, my name's Flegg, founder of Ethical Property Partners. In this episode, I'm going to be talking to you about how you can fund your property investments without having to go to the banks, without having to go to the bridging providers and pay 1% a month, 1.35% a month I was quoted recently, plus a 1% setup fee or 1% exit fee. It gets extortionate. In fact, a deal I was looking to do in London recently, just to buy it and refinance it 2 months later, was going to cost me £64,000 in arrangement fees, interest fees, etc. And so in this episode, I'm going to be talking to you about how you don't need to use conventional buy-to-let mortgages, you don't need to use bridging finance. In fact, over the last decade, I have gradually built, and the key word there is gradually, I've gradually built up my private lending to a level that's now in excess of £3 million. And these are from private individuals who have lent me money because, and this is critical, they are getting very, very disappointing rates of interest in the bank. The Bank of England base rate right now is 0.1%, and that's the same across the world. Governments are suppressing their interest rates so that they can kickstart their economies, which makes complete sense, so if you're a business owner or a property investor, then that's great news. But if you are a saver and you've got £100,000, £50,000, £1 million in the bank that you're wanting to live off, and there are hundreds upon thousands of people who are in that situation right now, in England, in Wales, in Ireland, and across the Western world, those people are hurting right now because they perhaps did their pension planning expecting to be able to get 6, 7, 8% in fixed rate bonds. So they expected to put their chunk of cash in a fixed rate bond and live off the interest. But now they can't do that because the interest is a pittance. So what they're having to do is to erode their capital. And as we go into a more sociable environment, so as we leave lockdown, our social interactions are going to start growing. And the reason I mention that is these interactions are your opportunity to help someone to build their pension pot back up, to start to live off the interest from their investment pot, rather than having to erode the capital that they're needing to live on. And so how does it work? How have I raised £3 million worth of lending from private individuals? And it can be anyone. It can be, I've had people that have done quite menial tasks for me, household tasks for me, that have surprised me by saying, Frank, I've got this chunk of money. I know you help people with money. What would you suggest I do? And so I always offer to source them a full market value property, doing a TDIC flip to them so they can become a landlord. Absolutely, lots of them want to do that because then they can share in the capital growth, they can get the returns, the cash on cash returns of 8% and above that we've talked about in previous episodes. But some people don't want to own property. My dad's a good example, didn't want to actually own property. He started getting cold sweats when he thought about getting a mortgage. And so, dad's a good example, I've borrowed money from these individuals on a one-on-one basis and I'm paying them a fixed monthly rate of return. Now let me talk about, before I go into the weeds on how you find these people, how you communicate the offer, how you structure the loan, let me tell you how I've not done it. And ironically, this is how most people try to do it. I have not gone onto social media and said, I am a property investor, I can borrow your money at this amount. That, in my experience, doesn't work. It also can get you in trouble with regulatory authorities, specifically in the UK, the FCA, because that's the Financial Conduct Authority, because you're not allowed to market a borrowing product or a lending product. You have to be authorised, you have to be regulated by the FCA in order to do that. Now we are regulated by the FCA and we run our Stepping Stones Housing Fund, which is allowed to market, and we borrow money into that fund from private individuals. That's allowed if you're regulated, but I'm not talking about that right now. I'm talking about unregulated lending, and that sounds bad, but what I'm talking about is borrowing money from people where you don't need to be regulated. They don't need to be regulated, you don't need to be regulated. If they are a private individual, you're a private individual, that is absolutely fine. The FCA are not interested in that. So what I recommend people absolutely don't do is don't start emailing your email list if you have one. Don't start posting on Facebook and LinkedIn asking for money. I think it just comes across as desperate. Unless that's your business and you're building a fund like we have done with the Stepping Stones Housing Fund, I suggest you steer well clear of social media and actually do this on a one-to-one basis, and then you're not tripping over all of those regulatory potholes, really, because I see a lot of illegal marketing of funds and borrowing and lending on social media, and who wants to be lying in bed worried about whether the regulatory authorities are going to come knocking on your door, because their powers are quite draconian. The consequences of breaking their rules can be quite severe. And so let's stay nice and clean, nice and cleanly and clearly within their rules. So when you are stood next to the other mums and dads watching your children play football, or at swimming club if that is open now, or at the school gates now that we're not homeschooling, etc., what kind of conversations do you have? Well, often people will ask, what do you do? And you can have that conversation with them about what you do. I invest in property. Oh, how does that work? And if they're interested, the little dialogue I have in my own head is this person interested in investing in a property, or is this person interested in lending me money? And it's normally one or the other. And so all you need to do is just share information and listen very carefully to how they respond to establish whether they do one or the other. And if you're not sure, tell them that you do both. Don't tell them what you do. Tell them what you do for others. So they're not interested in the fact that you've bought 10 houses in the last 6 months. They are not interested in the fact that you own 50 houses or however many houses you do own. What they're interested in, and this is very important, is what's in it for them. And so you might be thinking, yeah, but hang on, this is just another dad, another mum at the school gate. No, this is a prospective business partner of yours, and you have to treat them with that respect. And so the responses to the questions, what do you do? Oh, I help people to build portfolios or to invest in property without actually owning any property. And the objective of that first answer is to get them to respond with, oh, how do you do that? Because once they've responded with how do you do that, and this is the law of threes, and I'll cover that in another video. If you'd like me to cover the law of threes, pop it in the comments and I'll cover that in a different video. Once they've asked that question of how do you do that, that gives you permission to expand. Well, either I source properties for people, I refurbish them, I put tenants in them for them and actually manage those properties afterwards. That's a TDIC sales pitch. That's an explanation of how full market value armchair investing works for them. And that's something that I recommend all investors do because it's such good cash flow for yourself. Or for some people, they don't like the idea, this is in role play, for some people they don't like the idea of actually owning properties and having the responsibility of tenants and maintenance, etc. So what I do is I borrow money from people at a fixed rate. I can give them security on the properties and then just pay them a fixed monthly amount as if they're a mortgage lender, and so they don't have to worry about anything to do with the property. I take all that responsibility, but they get a really good return on their money, anything from 5% upwards. And I always drop that little 5% upwards in there because that £3 million that I've borrowed is anything from 5%, I don't pay less than 5%, all the way up to around 10%. And it varies massively. It varies mostly on the investor and it varies mostly on my desire for the money at that point. If I don't have any deals going on, I'll always borrow money at 5%, but if I don't have any deals ready, I'll borrow at a lower amount. If I've got a deal that I need the money for and there's no one around, I'll obviously start talking to people about slightly higher interest rates. The interesting thing is, once you've paid someone a higher rate, they're very, very unlikely to go down for a future loan, but you can always pay people more, of course. The other question I get asked a lot is, does it have to be secured lending? Amazingly, over half of that lending that I've just mentioned is unsecured. And so it's people just investing in me. They're saying, look, there's £50,000, Frank, there's £100,000. I give them a personal guarantee, which means that they have a claim over all of my assets. It would mean that I'd have to go personally bankrupt before they didn't get their money repaid. I've always paid all of my investors, by the way. I've paid all of the interest that is owed to them, and I've paid all of the capital that's owed to them. I've repaid people early if they've asked me to repay them early, if I possibly can, and I've paid them on time as as per the T's and C's of all of our loan agreements. I think it's critical, and because of that, lots of people refer others to me, which is brilliant, because if someone has a pleasant experience and makes really good returns from lending me money, A, they're more likely to lend me more money in the future, and they're more likely to refer me to their friends and family, and that happens a lot. And that's how I've grown quite organically. You've never seen an advert from me asking to borrow people's money, but if someone has a positive experience, then they're going to refer other people, and I can help them to make their money work harder for them, basically. Now, of course, secured money, so that's where it's secured by a charge or a restriction on a property, that's quite limited, because you have to have the property, it has to be unencumbered normally, so it can't have other lending on it. And if you want to refinance, if you want to sell that property, you have to repay the funds. Now that's quite limited, and the biggest problem with it is I keep having to go back to the people saying, oh, I've sold this one, would you like to reinvest in another deal? We then have to do the paperwork again, they have to make the conscious decision, do I want to reinvest with Frank, or shall I use the money for something else? Whereas I've got investors that lent me money 5, 6, 7 years ago on an unsecured basis, and they just get the monthly income, and I can put the money into one deal, I can take it out, I can use it on a refurbishment, I can use it to invest in some marketing, and it comes back. I can use it as a purchase, as a lump sum to purchase a property with other people's money, and then I can refinance and get it all back. So unsecured lending is preferable, obviously, but it depends on your level of trust with the investor. And if the investor says, no, I only want a first charge, then obviously they're perhaps going to have to wait a bit longer before I can use their funds. And so they're missing out on the opportunity cost of earning an interest rate on those funds. And then when I buy a property, they get their first charge on the property. So I just wanted to share that with you guys, because in these times of increased social interaction, people are worried about their money. A lot of people have more disposable money or more savings right now than they've ever had in their life, because they haven't been able to spend that money. So people have now got a 20,000, 50,000 more lump sum of money that they haven't had before. I've borrowed from 19-year-olds and I've borrowed from 69-year-olds. There's the whole gambit in between. Everyone wants their money to work as hard as possible. And most people recognize that if their money's in the bank at the moment earning 0.01 or 0.001%, their money is actually shrinking in real terms. Inflation is actually eroding that money, which is crazy. And if they're then taking out some of the capital to live on each month, their future is looking very, very bleak depending on the sums involved. And so as soon as they realize they can get a 5, 6, 7% return on that money, that's fantastic. Now, if you're borrowing money at 5 or 6%, you don't have to refinance. So I often will take a lump sum of money, £100,000, let's say, from an investor at a fixed rate of 5%. I'll generally pay it quarterly in arrears, because that saves on my admin and my team's number of statements a year, number of payments a year, etc., for a 5-year period. That means I can do a deal and just leave the money in it. I don't have to reuse that money at all. Now, if it's unsecured, I might choose to refinance, take the money, go do another deal. I can do probably 10 deals in 5 years using that same chunk of money. But if that investor wants security on the property, if they want a first charge, second charge, etc., then I can just leave it in for 5 years. And in 5 years' time, I can refinance, I can sell the property, I can take their money out, and I've made the capital gain. And if you think about it today, guys, if you buy a cheap flat somewhere up north for £50,000, what might that be worth in 5 years' time? 7% capital growth a year? That's pretty impressive. That's £3,500 a year. Let's forget about compounding, because I'm doing it in my head. £3,500 a year over 5 years. What are we looking at? £17,000 in capital growth. So you've had a £50,000 investment from someone. You've made money every month, 8-10% on that money at least. And so you'll be earning maybe £2,000 a year from the cash flow on that deal. And then when you come to sell it in 5 years' time, you've earned £16,000, £17,000, £18,000 on top. That's a fantastic deal that you've not put any of your own money into. And so these chunks of cash, you're helping these investors to get a high interest rate, and you're also doing deals that give you an infinite return on your money. That deal I've just described there, I've done multiples like that, by the way. That deal I've just described, no money down for me. No hocus pocus, no pretending it's worth this or buying it for this or whatever. I'm just taking an investor's money and I'm buying the property. I can buy it through an estate agent if I want to, I can buy it through auction if I want to, I can buy it direct from vendor, and I can buy very quickly because now I'm a cash buyer, nothing to sell, no mortgage to get, I've got the money in my bank account and I can demonstrate that to the vendor themselves. And they value that. I'm going to get a much better price as a result. Or how about use it as a down payment on a control now, pay later strategy? So some investors, in fact, I spoke to 2 investors this week, where both of them wanted some money up front. 3 million portfolio down on the south coast, commercial and residential. The vendors wanted some money up front, and so what I said to them was, yeah, I can give you some money up front. How much would you like? How about I give you £35,000 up front, just as a goodwill gesture, as a bit of skin in the game from me, because they're going to be paid actually over time and they're going to get the balance of their £3 million in 12 years time. And that £35,000 up front is going to give them that, yes, Frank's serious about this, he's not going to hand it back in 3 months time, etc. Well, the brilliant thing is that £35,000 isn't even mine. And so I've borrowed that from someone at 5, 6, 7%, and the cash flow from the deal is going to pay that to me so I can pay them. And then every penny on top, and there's a lot of pennies with that particular portfolio, is going to be money in my pocket, which is an infinite return. People talk about yield a lot. In fact, I had a client come to me the other day and say, that deal's not got enough yield in it for me, Frank. And I looked at it, I said, it's an infinite return. There is no money going into that deal, and it's going to cash flow, in that particular case, I think it's about £1,000 a month forever. Who cares what the yield is if it's an infinite return investment? And that's another topic for another video. If you want me to go into detail as to why ROI is so much more important than yield, then let me know. But guys, I just wanted to share with you, as times are changing now, as we're becoming more sociable, we're meeting more people, don't miss the fact that finance investment is a great win-win solution for you and many of your non-property investing friends and family. If you want to be notified each and every time that we upload a new video full of sophisticated property investing tips and tricks that you can use in your portfolio, hit the subscribe button, click on the notification bell, and then each and every time we upload some content, you'll be the first to get it, and you'll be the first to be able to implement that in your SPI business so that you can make more profit, buy more properties, and capitalize on this amazing once-in-a-generation opportunity to build your portfolio. Until our next episode, take care and happy investing.